All right, let's get going. Today, I have a slightly evocative title of the mechanics of money and risk. And mechanics is over there to remind us all that this is the Department of Mechanical Engineering. And money and risk is to alert us that finally we're going to talk about money and its price of money, which is risk. And to me, this is a new topic also. So probably you can see from the way these lectures are structured and the uncertainty and the plethora of errors that it's also new to me. But to me, it's a very exciting topic. It's where I've always wanted this field to go towards finance, since that's my background, apart from mechanical engineering, which is my real background, of course. And somehow an understanding of what risk is. Okay, risk is one of those shadowy concepts, so we know it's all there. And to some degree, we have a feeling that the price of money is risk. There's only two ways to make money: either you work or you take risk. So either you labor or you're an insurance company or you gamble or something, right? So those are the only two ways, right? So there we go. We're very lucky because this is a project we're doing together with Rabobank, a preeminent bank here in the Netherlands. And Peter, on one of the team, has also taken time out to be here, and we're very grateful. So Peter, budge in any moment. This is not a formal lecture in that sense. And let's get going. So let's see if this all works. And this is all, so what do I do now? So this doesn't seem to work. Oh, here we go. Oh, great, is it? Huh?
Last time we got it work.
Yeah?
Oh, there it was. Oh.
Oh, that's what we
Yeah.
want. And now, what? Uh-oh.
Yeah.
Oh, there we go. This is great. Huh? So instead of launching us, we already, last week, we did some of this already. The strategy I took to, rather than launching us directly into money, kind of give the basis of where this is all coming from. And the basis where everything is always coming from is the real economy, and maybe to an event that happened 10,000 years ago, or maybe 12,000 years by now. That is the when humans went from hunter-gatherers and started settling and had land and used that land to grow some kind of crop, like wheat to make bread, or rice if you're in the Orient. The idea was the same. Okay, and then rather than having one type of commodity, either meat or berries or something like that, or various types of commodities, you had a real distinction between the land on the one hand, which you couldn't eat, right? But the crops that it yielded on the other hand, which you could eat, and there was so much of it that there was a surplus of it, and you could start trading it and blah, 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 blah. You can start inventing money and civilization, and you do all the things that we now all take for granted for humanity, but we see animals do not. Okay, so it's a big step to make this distinction of one thing that is what we're going to call a Q, that is the Q0 or Q0, which is your capital, which is your land, and then the product of that land, or the harvest that you get, which is distinct from it, which I'm going to call Q1 here. All right, and these are flows, and the flow of capital is just called investment. So these early settlers, what they could do is try to acquire new land. They could buy it from somebody else, or they just had a raiding party probably and just go and take it. And that will be an investment. So investment comes from clothing, and you just put the clothing in, so on. So it's yours, okay? And you can start wearing it. And the flow of the products is just what we call the demand. So demand for apples or demand for corn or whatever it is. So we have slightly different names in general to distinguish these goods, okay? And then we see the product as sort of a return on this capital, okay? So it's very natural to look at how much crops we're making per year divided by the amount of land, which is the yield of the land, okay? So you see these things get tied together, and then the question becomes, what's the value or the price of this capital? Well, in itself, it's nothing. You can't eat it, right? But it has value because you can grow your crops on it, right? So this ratio is going to be the thing of value, okay? So it's a big step. So it's a big, big step that we made. We've always been doing it the Newtonian case, and now all the Q's were equal. There were apples over the oranges, and now we're making distinction between a capital and a product, and we're starting to look at these ratios. So if you're an engineer, this should remind you of the rotational analog, right? So what is an angle, right? You have just two coordinates, and you're turning like that, and you may look what this thing is as a ratio of the arm that you're dividing over, and then you will talk about the, don't do it with your hand. So did I screw this up now? Huh? The thing is, I'm not switching between the old style and the new style fast enough. Huh?
You'll get there.
I'll get there, yeah, when it's too late, when the lecture is over. Huh? All right, so this is an important distinction, and the intuition that we're already going to put here is that we're going to solve it as engineers between the idea of looking at, if you have a pendulum where you can solve it Newtonian with an x coordinate and a y coordinate, or one coordinate, which is an angle. Huh? And if you want a stretching of the string that holds the bob, okay, a little springiness, which will be, so the length of that string would be the capital, and the product would be this movement in the other direction, okay? Now, this is clear, but let's move now to the financial domain. Now, in the financial domain, the finance only came after this was invented. Like early man and woman didn't need any money. You know, they just traded one commodity for an apple, apples for oranges or things like that. Probably meat for berries, because apples and oranges only grow on these farms. And there you make a similar distinction. So what you do is when you make a financial investment, or you loan somebody money, there's the principal sum. Those are the funds you provide to this person to go do with what he wants. And as a reward for letting him loan those things, he gives you something else, and that is what's called the interest, okay? And the word interest kind of comes from the fact that you're interested in it, right? Huh? Like you have an interest in this capital because your interest is getting the product, okay? All right. So depending if you're the borrower, then you have to pay the interest, or if you're the extending the loan, then you would receive the interest. All right. So the idea is that interest is like a product of the principal sum or the funds that you're acquiring. Yes.
Wouldn't you call the demand the return? So the return on your
Yeah. The return would be the demand. The problem is that this is the return in, it's really the crop yield, right? Huh? This is a good question because there's just a lot of confusion, right? So this is the demand for this product, right? Huh? So it would be the demand for wheat, okay? And this would be the demand for capital, which we call investment. Now, when you look at Marshall's book, he only talks about commodities, okay? So he doesn't really, the theory of investment is considered separately, and demand for capital is just not considered to be a real demand, okay? So because there is so little of it, most of it is just a static thing, okay? So that's why I call it demand. You can call it return, but usually a return you divide the two, you know? And you look at sort of a rate of return, you know? So I find it confusing. The term is used in everything. I use it here to say that when you have a capital, you get returned to you a flow of this product, okay? And that comes back, huh? It returns, huh? So it's just a generic term. So this would be, this principle here is also these are usually called the funds that you provide, but you can also think of it as financial capital, right? So this could be financial capital. And people will say that investments is all about, people with excess financial capital providing people who need financial capital, okay? Huh? So then you can see that principle and capital have the same idea, all right? Huh? Yes?
Why is it then interest and not money?
Well, this is the interest income, huh? I mean, this is the total interest income. This is I have to say, this is the interest you've received in total. Huh? So this really should be the interest received. Okay?
But the product kind of is the money.
Yeah, but this is, okay, so this is the thing. The principal is in dollars or euros or whatever you want, right? Huh? And then you can repay it. That's also in dollars, but you can do a repayment of this. So many things you repay a year or you borrow something more, right? But the interest you received is also in dollars, right? Huh? So your income would be in dollars per year of income. But these are two separate, these two flows are separate. Oh. I'm not sure how great this thing is. Huh?
Me neither.
Okay. So, but you have to see that these are separate, these are dollars, they're both measured in dollars, but they're separate things, right? Okay, this thing here is measured in machines, and this is here in bushels of grain or something, or hectares, huh? Okay, but here it's all measured in euros or dollars, right? And then even the utility will be measured in dollars, and the whole thing gets very confusing. That's why I'm making this real financial distinction. So this is the real economy. It serves as a model for this. And in this thing, all the units just kind of fall out, okay? All right? The point is that if you're doing engineering, you can put this thing, all you have to do is keep track of your balances, right? So you have the balance of how much you borrowed, right, which is this one, and you have the balance on how much interest you paid or received, which is that one, right, Q1. And then you have to keep track at how much you keep borrowing more here or repaying, and how much interest you're getting at that moment, right? Okay. So those two things are of importance. So you have a position, that's where you are, how much interest you've already acquired and how much financial funds you have, all right, and how fast you're going. And then you have a nice state space of a mechanical system, all right? Okay? Is that clear? I'm happy with these questions because if you got that a little bit confused in the beginning, then the whole lecture becomes like one big, what's going on here, right? So you already see what our problems are now. So now we're in a nice base space and a tangent space. We got a velocity, we got, it's a four-dimensional space, right? But now we have to find out what are the prices that belong to these flows, right? Because we want to write, these nice little demand graphs. Here is the P1 and V1, and we have a P0, V0, right? Huh? And then we know Newton's law will tell us how the law of demand goes. And this is the demand for money, but separating demand for funds, which is the investment, and demand for interest, right? They're separate demands. Huh? This is an investment demand, and this is, for a return. Huh? Okay, so as a customer for the bank, I guess it's their customers. It's always difficult, but the bank has 2 points of contact. Those who give their money to the bank, the depositors, those are the guys with the checking accounts and all of this, and the guys who borrow money from the bank for their business, okay? So the guys who are borrowing, they're interested in getting this, and they got to pay that. And the guys who are depositing is exactly the other way around. They provide their money in their savings account, and they hope to get some interest on it, okay? So the bank works two sides, right, of this, like any business. If you look at Rumo's business or whatever, they have a price on this side for their customers and another for their vendors. Huh? Okay, so this is the picture. So we are worried about what these prices are. Huh? You think you can scroll this thing down? I'm afraid to screw it up. Huh? Huh? Oh, then we go back to here. Oh, this is what I got to do. Huh? And now, oh, now you got to do that. Add text. Huh?
We'll have to go out and draw modes. Super.
You have to go out of the draw. Now this is trivial. All right. So what I want to do now is take the next step. Start attaching prices to this. Now, in the old days, before you knew about Lagrangian analysis, what you did is you just draw a demand line, and you said, well, that's Newton's law, and be done with it. And this is the mass. Now, you guys know Lagrangian mechanics, so we're going to do it the right way. Now, why is the right way better? Because if you do it the okay way, you never really know what this stuff is. You know, now you have strange interpretation what the price of money is. And you start guessing, and you hope it works. The Lagrangian approach will just tell you that, okay? So this is our first real benefits that we get from taking this perspective, okay? So what do we have? We have this utility over a period. So we look over a period. We have this Lagrangian function, and this thing now is and this thing here, remember, this is a vector. It calls over, it's not a vector. It consists out of two, our principal sum, our financial capital, and the interest that we are receiving, okay? And this thing consists of these two velocities, right? Huh? So there's a bunch of them. In this analysis, I'm just not going to worry about this. I'm just going to use this little v here as just a generic one, just to get the ideas lined up. So there's, what's the way to get a price? Well, you take just this Lagrangian, which is your utility, right? But this Lagrangian also, don't forget, is also, again, in dollars is in dollars, right? So now what I want to do is say, well, how much does my utility change when I have a little bit higher demand for either funds or for interest, right? So I want to receive more interest or I want to borrow more money, okay? Now, what's the extra utility to me for doing that? That's the question that this is asking, right? So how much does my utility increase if I borrow more or if I receive more interest, okay? Or if I loan more, or if I can get more or less interest, okay? Those are the two prices that you're going to keep track of, all right? Now, if these were goods or capital, you can say that's the price of land if this is the zero, right? Or the price of wheat if this were the wheat that you were doing that, all right? So it would just be the regular price, okay? But what would it be in finance? Well, let's first look at the units. It's Lagrangian and it's in dollars per year, and we do a partial derivative with this flow, which is also, I'm writing euros and saying dollars, but it doesn't matter, right? So what do we get? We get nothing, right? So it's a percentage. So this is kind of confusing, right? But what is this saying? This is saying how many utility dollars is it worth to get one real dollar of what? Well, of extra funds. Or what? Of extra interest, okay? And that's a percentage, okay? Now, if that percentage is 100 or is 1, then you're saying this is dollar for dollar. So an extra amount of income is worth to me an extra dollar, all right? If it's less, right, then you're saying, well, an extra dollar is going to be less worth to me, okay? Huh? So that makes sense, because suppose you have a very high income, you're making hundreds of thousands of euros, and you get another 50 euros, I mean, doesn't really matter that much. But if you're making no money and somebody gives you extra 50 euros an hour, well, it's doing good, right? Huh? Really happy, okay? So you see this works out. So low incomes will have, high, prices for money, and high incomes will have a low price for money, right? So you would multiply the amount of money you get by this factor, okay? And this is true for whether it's interest income or other types of fund, whether it's the capital or whether there are reserves. The bank also has reserves. The bank has some investments. They have all kinds of stuff on their balance sheet. And all of these would have to be multiplied by the price, which is just some factor, right? That tells it how much it's worth for the bank to have that. And sometimes accountants do this. They say, at this point, this stuff is worth nothing to us. And they call that a write-down. Right? They don't really do it very clearly. They don't kind of ride the demand curve, but once in a while they just write things off and they knock off 20% of the value because they think, oh, we had it appraised and looks to us as worth less, okay? All right? But in economic engineering, you would do this in a systematic way, right? You just have this demand line where the price of money, which is in a percent, is dependent to you, so that's the value to you, your price, is dependent on how much you're getting, right? And the more you get, the less it's worth to you. All right? That's a basic assumption. Now, this thing has got a name in the literature, and it's in the finance. It's called the risk adjustment factor. And I'll get to that, why it's called that. So here you see the word risk for the first time showing up. But what's important is that the interpretation of the price of money, you see, a lot of people think the price of money is always one, since you can do $1 for $1 always, but that's not true, right? Then somebody say that the interest rate is the price of money. That's also not true. The interest rate is the return on money. That's not necessarily the price, okay? The price of money is the risk that this is something rather shadowy, and this is just what we call risk, So if you loan somebody money, or if then you probably are taking risk, the risk that he won't repay, And if you're paying if you're receiving interest, you're also taking risk, because the risk that he won't pay the interest. So you get a reward too, there's no doubt about it, right? But if we think of the price, we think of the negative, and we associate it with a risk. So in a very broad sense, the price of money is risk, okay? Now we can also look at the economic forces, the wants. That's sort of the convenience of having this type of money, right? So banks do that sometimes. You can imagine that if you're rich, then you got all this extra money. You don't really care that much. And if you're poor, it will be very convenient to have more money, But this is just money you have in stock. Now banks have certain accounts, like reserve accounts, where they have. This is money they keep on hand in case there are some liquidity problems. Then they can pay it out immediately. And this is an account of funds that they have what they call a desired level, say at 10 million or something. And then this will be this. And then if they go below that, they start freaking out because maybe they can't bear it. So it becomes very inconvenient. And when they're above, they have this extra convenience. They also don't like it, want to get rid of it. Just like you would have just a regular commodity in storage. You have an inventory level that you think is your desired, and if you have too little, you kind of don't like it, and maybe too much, you don't like it, you try to get rid of it, and trade it off. So that's just like a spring would work against the mass, right? So this is the mass here. It tells you what the risk is. Now this tells you how your buffers are doing, your reserves and your capital requirements. So you may have some shareholder capital, and you may have too much or too little, because if you have too much, you got to pay these people. If you're too little, then you can go insolvent. All right? For now, we're just giving a sort of general thing. Usually in the literature, they're kind of shadowy about this means, but you can see it's sort of a precautionary special motive. A motive, when you see the word motive, it's always a good suggestion that it might be an economic force, right? Because a motive is not the thing itself. It tells you want to do something. So if you have a motive precautionary motive, you may want to execute a price change to adjust your risks, right? And this is precisely what the Euler-Lagrange equation tells you, is that's the only way to carry out your motive. And it's also the thing that reminds you of an electromotive force, you know, it's the motivation to increase the magnetic flux in the coil. Huh? Or Newton's motive force is the motivation of that mass to go faster. Newton called it the motive force, right? So I like always when you see the word motive and economic motive is to think of it as a force and then define it like Newton did, right? That this motive in a monetary economy or in an economy gets translated in a price change. That's the only way to communicate your motives, right? All right, and of course, if you have price change, you will see that you're demanding more or less, right? Huh? But that's a consequence of the motive. Huh? Now, the second derivative, that's the mass or the inertia, that also has a name. That name is the risk aversion coefficient. All right? Now, why this is this case, this is the topic of the next slide, if I ever get to it, with this wonderful new system. But this is just a table of some, I just wanted to lay this down. This is just a table of some concepts that, you know, that are there, and you just, you know, just getting comfortable with these, this terminology. So a price is a risk adjustment factor, and the mass, the inertia, is the risk aversion coefficient. It's a little bit confusing, but not too much. Right? And then these things, it's just, it's always different. Huh? Okay. Now, what was Kuhn doing? He would first do this, then he would do this, then he would get out of here.
Again.
Another time?
Yeah.
And then you got out of here, and then I can go
Touch the board.
touch the board, yeah. And then I'm allowed to do this.
Yeah.
Yeah. Look at them clapping. Huh? Finally approve of something I did here in the front of the board. Huh? All right. Now what I want to do is first give you the surplus situation, because it kind of clears things up a little bit, and it also immediately makes the connection with the risk aversion story as it's known. Okay, so you know how you can find the Hamiltonian. It's you just subtract from P times the price times the total demand, right? You subtract the utility. And actually, what you try to do here is you use this to define the price as the price as which this demand is maximized, right? The velocity is maximized. So either the flow of fund is maximized or the demand is maximized, okay? And this is the picture we've had before. And then you can find out that the difference between this, your revenue, and your utility, that's exactly the surplus. Huh? Okay? So the picture in the regular PV diagram is that this area here is your utility, and this whole area, this is your surplus, and this whole area is your is this factor P times V, your revenue or your expenditures. Okay? And then this price here is the slope of that line. This is just a picture we all know, right? Now, why did I bother to do all of this? Compare that with this picture, okay? I just snagged this from the internet. I think this is the second picture I found. The first one is Wikipedia, and it has a little less commentary, so I didn't pick this, okay? This I have here to illustrate why these names are chosen this way, like risk aversion factor. So this is what they call a risk aversion factor. The U is the utility, the X is so this is our flow, this is our Lagrangian, right? Huh? And they plot it like this, but don't forget our Lagrangian is a disutility, and we minimize the action. So just put a minus sign. So what will happen, this thing will just flip around, and you just shift it up a little bit, and you get this picture. Okay? Yeah? All right. So when you look at this, you will see that basically these pictures are the same. There's one or two critical things they don't do, is they don't use it to define the price of money as a tangent here, but they almost do it. They almost do it, right? Huh? So they will talk about this difference between these two utilities, okay? The other difference is that they don't consider this thing just as a regular variable like we do. They consider it like a random variable, okay? So we just say, okay, now the demand is higher or it's lower, but they say the following. No, they look at this thing called, and that's actually the topic of the next slide. Let me just go a little slower here. The first point is these are the same. This would be our Hamiltonian. They actually don't do that. I watched a whole ton of little YouTube videos and read stuff, how they really do it, but they don't really look much at this. They would love to. They say this indicates everything, but what we do is we look at this difference here. And this is what they call the risk premium.
So looks like what they do is they compare the expected utility to the utility of the mean of the consumption, right?
Yeah, so they look at this distance here, right?
Because so it's the expectation of u of x, and that's smaller than the utility of what you would expect x to be.
So I'm going to explain why the
Yeah.
expectations are in the next slide. But first I wanted to show what the risk premium is, okay? So we look at this and we say that's the surplus, okay? But they look at this and they say, well, there is here a difference in the flow. There's the flow that if you're Lagrangian with a straight line, this would be what you would do, but it's not, so you're going to sit out here. So if you can see there would be a definite difference in this velocity, right? Now, what they do is they don't really have this interpretation of the price of money, what they have, and this is used by insurance companies, by the way, okay? And if this is money, it's very tempting to say, well, this would be one income stream, and this will be another income stream, right? And what I want is the higher one. And that's what the insurance company does. So the insurance company is going to say, well, we assume that we are not risk averse or risk seeking. So so the second derivative, that's the convexity of the line, that's the mass, right? So that's how risk averse you are. And the idea is that the less risk averse you are, the flatter your Lagrangian, so the closer it is to this revenue line, and then the nominal profits are going to be quite small compared to, So this is their idea. Now, instead of measuring that, they talk about that distance, but they don't really calculate it. What they do is they compare the two cash flows. And they calculate the difference in the cash flows, and that they call their profit, the accounting profit, because that's what's coming in. But that thing doesn't account for the risk that is borne by this, okay? So the Hamiltonian is a much better measure of this, much more efficient than accounting profit. Just because you're making a risk premium doesn't mean that you're doing good business. You may be overpaying for the risk anyway, okay? But this is what they do. And this thing is, this is here the risk premium. There's difference in these, the cash flow, what you would get, what it's worth to the person who insures himself, and what it's worth to the insurance company. So this is the risk business. The risk business is like any other business. You get somebody who's really nervous. You just bought a new drill for 100 euros at the Hornbach, and the guy asked him if he wants insurance on it because he's afraid of losing his 100 euro drill. And then you got to pay 10 euros for the insurance on the 100 euro drill. And if you have no money, you just kind of do it because you can't afford to lose it, or an iPhone or something like that, right? So the insurance company says, well, we're just getting all this risk premium, and then, But they need nervous individuals, right? Poor people, basically. And not nervous, poor people, because they can't afford to make the loss. So they're very risk averse. Okay. So it's different. I mean, the interest of this slide is how our ideas of Lagrangians and Hamiltonian and profit and fit into the normal way these things are looked at. Okay, in insurance and other things. Huh? The second of his interest of this slide is on the next. No, but if I don't take it off the pen, it's somehow not fine, huh? As I just noticed. Huh? So apparently I decided to put it in this slide anyway. So now what they do is they actually do not consider, and the insurance company doesn't say, well, if the cash flow is this, or what the cash flow is this, or what if the income is that. They don't look at it as a deterministic problem. What they do is they say, all right, we know we have something they could call a gamble or a bet. Huh? Oh. So they'll say there are 2 points, call this the point 0. So that's this point over here, okay? Don't worry that it's floating off, okay? So this is the 0 flow, huh? And then call this some point, the flow V, whatever it is, right? And then you do a bet where you have some probability pi times this flow V that you get, or you, so for one, or you get absolutely nothing with 1 minus p, okay? So if everything goes well, you get this flow, and that's worth that to you. If everything goes bad, it's worth that to you, right? Now there's a theory, there's several ideas you can do, but what's this bet worth? Well, what it's worth, if say it's 50-50 bet, we're throwing a coin, then you might say this is then the expected flow, right? So this thing here is the expected value of what I'm going to receive. If I'm going to receive either V with probability half, so this would be a half then I'm going to, and 0 with the probability another half, and this would be V over 2, right? Huh? Okay? So you can vary this probability pi, and so you can see you can fill up all these points here with bets. Now this works, of course, if you can repeat this bet a gazillion times. Then you can just assume that you're going to get this flow. And then we can take it as sort of deterministic, and you can fill them in, and you can say, well, this is my demand line. But you don't. It is not, right? Because this thing has a different utility, you see? So what you really have to do is look at this point here, the utility of that flow, and compare it to the expected utility of getting the flow, okay? And that difference, that is precisely your Hamiltonian, okay? So, and this explanation, this idea, which is kind of equivalent to wiggling the thing around enormity, that's the same as it is in the calculation of the Hamiltonian, right? It's the Hamiltonian is the expected utility minus the expectation of the expected flow, okay? And that's precisely your profit, okay? How much is it worth to you, and how much would it be? How much am I getting on average? Huh? So if I give you a bet 50-50 for a euro, we do, how much is that worth to you? Is that worth 50 cents? Maybe. What about 1,000 euros and 0? How much is that worth to you, that bet? To get that bet, how much would you pay me? 500 euros? No, more. No, less probably.
Nice.
So you either get okay. So let me say this. You either get 500 euros for sure, or you get a bet on 1,000 euros. What would you prefer? What about 400? What about 300? Probably the 300. So I have to go. I mean, this is a student, right? So you can see the guy is pretty risk averse. So Ozai is something, it's like a horrible. Huh? So now if we get somebody with more money, you'll see that his breakdown point is going to be, like this. Huh? And then we go to Bill Gates and ask it. He goes, okay, 500, all right, 499.9 or something, right? Huh? So you can see the convexity. That's exactly your risk aversion.
Even be higher than 500 for him.
Some people it's higher, so they argue this, that suppose you go to the casino, you pay more for a 50-50 bet than the expected value, right? So then you would be risk seeking, which is kind of ridiculous because you have negative mass, right? So with negative mass, particles with negative mass, they don't exist. They do exist. You have this antimatter, except they don't last very long, right? Now, let me ask you this. Somebody who is willing to pay more than 500 euros for the bet, is they going to last very long? I don't think so, right? Because you're going to do this a million times. He's going to lose a lot of money, right? Huh? So these people are around, but they just don't last long, The other explanation you can have is that you say, well, if they don't last long, they're all dead, which they all go bankrupt, gamblers, right? Why do they keep doing it? And the only explanation I see is that they get some enjoyment over the excitement, because their lives are kind of boring, or I don't know. Maybe there are gamblers among you where you're insulted now, but their lives are boring. They want some excitement, so they're just going to go out and lose some money. Huh? But I know one thing, I used to play cards and I used to poker a little bit for enjoyment. Then you would lose some money, you would gain some. It was a 50-50 bet because it was among friends. But when I was on the stock market, I lost my taste for it. And man, I had that's the last thing I want to do with my free time is take more risk, I just want to, have something for sure now. I'll prefer that beer and just sit down and do nothing or go skiing or something, and be outside. But so I think there's something to the story that when you go to the casino, it's a little bit more, you just lack excitement or something. But, risk-seeking people, you can see them as antimatter, I mean, it exists. But as soon as they come in contact with any type of matter, they're gone immediately. And that's why there is so little antimatter in this world, and all the mass is positive, and that's all individuals are more or less risk averse. If that was not the case, insurance companies wouldn't make money, and we know they do. Okay? If there were a lot of real sick people, all the insurance companies would be bankrupt.
But so as an insurance company, are they risk seeking?
No, they are risk neutral. That's the idea, right? So they pool a lot of funds. So the investors in Lloyd's of London, they put in an enormous amount of funds. And if you have that, you can pay out the little things and you just receive on the average. So you work with the total averages, okay? So they are what we call risk neutral. So, yes?
Risk neutral really risk neutral, or so risk averse that compared with normal people, it looks neutral?
Well, the definition of risk neutral is that the mass is zero, right? Now, is the mass
always positive? Positive or zero?
Yeah, positive or zero, right? Whatever. I mean, that's the definition. Now, you can say, is there in practice somebody who's physically risk neutral? I doubt it. Is there really an object with zero mass, like a perfect spring? I doubt it very much. You see? Or a damper, it doesn't have with no mass. I doubt it.
Photons.
Protons, they have no mass. Yeah, that's right. They're not really engineering elements that you can put in your circuit, but they have zero mass. Right. So that's a risk neutral thing. Is light. Light is a risk neutral, right? Well, that's clear, right? And then we use it as a to measure things, measure time, distance, because it doesn't get affected by other masses. Well, it does, but it's a standard, right? So yeah, Yeah, so I mean, there in the literature there are big discussions about this. I think as an economic engineer, all you have to see is that the coefficient of risk aversion is just the mass, okay, and just be done with that, okay. All right, and it just tells you how convex your Lagrangian is, which is the same as the concavity of the utility function. All right, just be done with it. And then if somebody asks you a tough question, you translate it into engineering or physics. You say, well, can you have negative mass? And you say, oh, yeah, well, it just exists. Oh, okay, fine. Huh? Huh? Now, don't get too philosophical about this stuff. Anyway, this is a connection with insurance companies, risk premia, and all this stuff. And okay, and here you also see a connection to something, to a branch of finance. All right. Now, how do I get out of this one? Huh? This one is, oh, here we go. Oh, whoa, whoa, whoa.
I think just turn off the draw.
Yeah. You have to turn this off, and then
Press that board.
Then press the board, and then go. Yeah. All right. So this brings us to this idea of this kind of reiterates what I said before, that the expected utility, this utility is smaller than the expected flow of funds or interest flow or whatever. Okay. Huh? And this bet that gives you with probability pi, this flow, and 0 elsewhere, has a name. It's called the Arrow-Debreu security. There's 5 other names. If Britt were here, she could tell us that. Basic security of this or of that, It's used in finance to model all possible securities, okay? So you have these securities, like a bond is a security, and they can have different payout under different circumstances, so you can calculate the average cash flow, expected cash flow, and you build them up with these things called Arrow-Debreu securities. These are 2 famous economists. Debreu is the one who took partial equilibrium that we're talking about and extended it mathematically to general equilibrium. Arrow is a Nobel Prize winner. I guess he got the Nobel Prize on this stuff, if I'm not mistaken. Now, the way these guys do it, they have something that they call risk-neutral probabilities. And so they calculate the expected utility. So this is the negative of the Lagrangian. And I just took a change in the cash flow. So you have this cash flow, and you can get a little bit more. You can do anything you like, but it works out really nicely here. Then I replace this utility by the negative of the Lagrangian, and this is this is a change in the cash flow. So that's going to be this, which is the price. And if I look at the expectation, I'll just get the probability times the price times the change in the cash flow. Okay? So what we would say, this would be the value of the thing. Huh? So you take whatever cash are coming in, and this is some coming in more, but I got to value it at my current price, what it's worth to me, right? So this is my risk adjustment factor. And then there is this probability of getting it. So I'll have to multiply it with that too. That's how we would do it. So we would think of this as the utility, because this was the marginal utility of this cash flow, and this will be then the probability. But they don't do it like that. They think of pi times p to be a new probability. It's a little bit crazy because this won't add up to 1, so they make it add up to 1, and then they multiply it by what they're getting. And this is called a risk-neutral probability, because under this probability, it is as if he were risk-neutral, because you factored in the price of the money, the risk adjustment factor, in the probability. Okay? This is just what they do. This makes it confusing when you're trying to compare the 2 approaches. But it's easy because a lot of people look at the expected value and then you can say, well, I do it under the risk neutral measure. That means I can just calculate with expected values without worrying about utility because I built the utility in my probability. It goes a little bit against the spirit of subjective probability where you separate them. Huh? Why build the mass and the force, right? Huh? Or the velocity in this case. Huh? But nevertheless, that's what they do. And this is an example from a famous book by a famous professor, Rubinstein, I think. So you can see he's explaining this for finance students. So he has this bet, you know, this insurance. It's always about insurance companies that they use. So you can have some earthquake, and this is the intensity on the Richter scale. Here's the damage level. And then you see the payoff of the insurance company. Yeah? So that's your cash flow. That's what you're going to get, right? This is going to come in your cash account, right? Huh? And then this is your probability of that happening, or insurance company's probability. Huh? Who cares? Huh? And then here you see, this is our price. And here you see why I call it the risk aversion factor, or they call it an adjustment to the probability, all right? And then they multiply these two, and they renormalize, so they get this risk neutral. I call that pi neutral. They call it Q sub S. And then they can calculate what the price is, okay? So the true price is, of course, the price times the amount, huh? But then they also have to multiply by the probability. Huh? If this probability is 1, which a lot of our cases we will look at, then these will all be 1, but these will still be there as momenta, you know, and the whole. Huh? This is just to show you how this fits into the way they reason, okay?
How do they find YFS?
But it's interesting to see. It's kind of on a straight line. But if you plot this, I did it. If you look at this YFS, which is your P, right? Huh? And then you look at the change in this, you'll see that it's approximately straight. It's like, it's almost like it's built in that P, you know, that this is the payoff, right? Huh? This will be the price. Huh? All right.
Because the numbers are so specific.
Well, because they needed to add up to 1. So they took some weird numbers and then they renormalized it so that this thing, the sum over is equal to 1, right? But he pre-normalized this thing, right? That's what's going on. So he probably took some guesses and then he renormalized. Here you shouldn't renormalize, obviously, when you do it this way, right? Huh? I mean, that's the worst thing to do. You're just well, you could. You're just going to for different scale of utility because you're allowed to multiply the Lagrangian with a different number. But you can't go to another problem and then rescale it differently. All right? Huh? All right? I mean, personally, but I'm an engineer, I find this hyper confusing. I mean, I prefer to do it this way, you know, the regular way with Lagrangians and all. This is okay, fine, that's the utility. And also, I prefer decision theory over this finance stuff, but you know, this is all my preferences. They do what they do, and our job is to make the connection between engineering and what these guys do. So this is the connection. So you see, it's very satisfying to see this, okay? That all these things fit into our Lagrangian approach. And it also shows you how powerful that approach is, all right? And the real power is going to come from now, because now I want to get down to business, okay? This is all a prelude to doing business. So I'm going to talk about duration and more duration, utility of interest. I want to go to the rotational case. And then I want to look at the ALM problem of assets and liabilities as the two-body problem, right? It's a famous problem, okay? And then how they do, you know, and then extensions of this two-body problem, and just basically sketch out how this will go. So Let me give a short introduction of what I want to do, and then we'll take a short break, and then we'll keep going, okay? Because we have quite a bit to do. So the short introduction is the following. Look at this thing. I showed you this last time too. Huh? So you remember we have two flows. We have this Q0. We have this Q0. That's this one. Right? And we have this associated with it is the product on it. That's that one. This is a statement of a bank, Bank of America. All right? So you see they have different things, different loans. These are the assets, the liabilities are over here. So this is where they're collecting interest from, and this is the liabilities where they have to pay interest to. It's just a question of a sign. Okay? All right? So you see it makes it very, very explicit. Huh? What's going on here, this balance sheet. So there's really two things. This idea of having capital and the product of the capital is built right here in the balance sheet. Okay? So you have to keep track of those two cash flows separately. Other companies won't do that. You always have some regular company that will just have one column here and everything is coming in. Okay? This is, they keep it separately. Then there's another thing they do is they divide this by that. Okay? That's this column. That's what they call the yield, these guys. That's because it's a US bank and there are some US regulations. One you can call it interest and one you should call it yield. But yield is actually a nice name because it tells us it's like crop yield, you know? We're getting so many crops, right, on this land. Here's the land, here are the crops, right? And this is, here it's a percentage per time, right? Because this is a flow and this is a stock, huh? All right, huh? It's nice. So what they're here doing, you see, is you can see what they're doing. They're taking this V1 and they're dividing it by Q0. Okay? So you take this V1, here is Q0, and you're dividing this by Q0. And what do you get? Well, you get the angular velocity, right? Okay. So what's going on here? All right? That's what we have to get to. What's going on here mechanically in this column? Well, I'll tell you what's going on. They are switching from regular Cartesian coordinates to angle coordinates. Okay? They're describing the same problem. So you could have this pendulum, and it's here, and you can say, well, this is the Q0 direction, and this is the Q1 direction. Well, you have to have them out here, right? Huh? This will be more the V's. Huh? Or you can say, well, I'm going to look at this angle here, right? Huh? And this angular velocity. Huh? I guess they're both. Huh? And I describe it that way. Right? So that's what you got to see. This is a way to change, you know, to a set of angular coordinates. So what if we now look at solving this problem? What is this price? Well, you know, we're sitting here in this way. You can look at the momentum in the 0 direction and the momentum in the 1 direction, and you can give that names. So you can call this prepayment risk because this is the risk that people are going to pay off their loans and things like that. You can call it anything you like. Sometimes it's called interest rate risk. The other name is credit risk, that people are not paying their interest payments. Huh? So that will be measured by these risk adjustment factors, right? But now what we want to do is we want to go to a different set of coordinates where we assume for the moment that the principal is a constant, okay? So we can calculate this angle. So it changes a little bit slower. And then go to a new set of prices, okay? That's the big step. I want to sketch this out and then take the break, because otherwise you guys are way too relaxed, because the first part was the easy part, okay? I'm going to hold you on here for a little bit. So how would that go? Well, we can define a couple of things. Well, first of all, here I've already defined the interest rate, right? Huh? So that's just this angular velocity. That's clear, okay? Any engineer would agree with me on that one, right? I see some people looking worried, huh? No, good. The next thing to define is to say, well, what's this thing, okay? So I take the price that belongs to the interest that's coming in, and I multiply it now by the amount of the of my capital, right? Huh? So what do I get when I do that? Well, now we go back to this idea of Kuhn. This is the return, right? So you get a return on what? On this capital. So the value of that return, you multiply you by this amount of capital, okay? And you get some price. It's more of a value, but it's always called a price in bond trading of that bond itself. Because the bond, this loan, that's a piece of paper. That's not worth that much. The value of it is all in the interest you're going to get. So you take that sum and you multiply it by the price that you are assigning to interest. If that's 1, then that is great. Then that's the value of this bond, okay? Huh? But if you don't want that interest, all of a sudden the land is going to be worth less to you. If this price is 0, you can't sell your crops. You don't want them. The land is worthless, okay? So the critical idea is to take the price of your capital and multiply it by the price defined canonically, okay? Not some weird price, okay? But this adjustment factor, the dollar for dollar adjustment, and multiply it by the price of the return, okay? And what do we call this? This is the angular velocity, right? What is this thing? If I take the linear momentum and I multiply it by the arm. Does anybody know? The angular momentum, exactly. All right? You know that. Now that I say it, you really know that, of course, right? I have this blob here. This is the arm. This has momentum P. What's the angular momentum? I just multiply that by that arm, right? This, the capital or the principal forms the arm. The regular momentum is P. Huh? I multiply that and I get the angular momentum, right? Huh? So the price of, or the value of this piece of principal is exactly analogous to the angular momentum, all right? Okay? This is important. So we had these prices, they were just adjustment factors, risk adjustment factors. But now we're switching to the rotational analog. So instead of F is M times A, we're going to say the torque is related to the change in the angular velocity, all right? So we need some new concepts. And that only is true if we have this idea of a bob and an arm and things like that, okay? This is the step we're making, and it's suggested by this balance sheet here, all right? Huh? That's the angular momentum. Now, I'm going to do something funky, because I need to define a couple of terms that they use in banking, all right? And they may not necessarily have one term they use in banking, and it doesn't have a direct analog in engineering, but you can see where it comes from. Now, you can see that if you want to relate the price of the bond to the interest income, okay, that if you multiply the left side of this equation with Q0, you got to multiply that side, and this should be a 1 here, right? you get this equation, right? So you get a new kind of mass, which is the old mass times Q0, right? It doesn't really have much of an engineering interpretation, but this is what finance types will call the Macaulay duration, all right? So what is the units of this? This is in years, okay? That's easily verified. This is in dollars per year. This is in dollars, right? So this must be years, okay? So it's a measure of the timing of this flow of this F1, right? The V1 flow, right? So the V flow is coming and you multiply it by its timing, right? So if you just have a bond that pays 1 coupon after like 10, you would multiply it by that 10 years, okay? And then if you do that, you get the price of the bond, okay? And this factor here is called the Mccauley duration, all right? So it's the risk aversion times the amount of capital that you have, right? This is something we don't really use. What we do, we immediately plug in, for this V1, we try to plug in this, so we have to multiply by another times by Q0, and then we get this equation, and then we define mQ0 squared to be the moment of inertia, okay? And then we have that the angular momentum is the moment of inertia times the angular velocity, all right? In finances, we'll say that the value or the price is what they call the money duration, so because it has dollars times year, or sometimes dollar duration in the United States, times the interest rates. Now, what's the meaning of this? Well, if I just take a differential on both sides and I divide by d omega, I can see that my money duration is dl d omega. Okay, you see that? Huh? That's easy, right? Huh? Actually, this is just saying F is m times a, but then this is the change in angular velocity, and this is the change in angular momentum, right? Huh? All right. What is this saying economically? That if you change the interest rates an amount d omega, the value will change some dl. Huh? So you're looking at the amount of value change per change in interest rate. This is very interesting to them because they're sitting there and all of a sudden they'll realize they're going to get less interest on this. This is like a bond that pays less interest or a mortgage where it's adjustable rates. So all of a sudden you're going to get. So how much, if you have these bonds, how much are they going to lose in value? Well, that's exactly DL if the interest rate changes this little bit, okay? So the amount of value lost on any type of loan is precisely the money duration, okay? In engineering, the change in angular momentum over the change in the angular velocity is actually the moment of inertia, right? Now, this is a good moment to stop because here's where we need the pregnant pause, you know, because a big step has been made, and in the continuation of this lecture, I want to exploit it to do ALM, okay? Because you can have assets and liabilities, both you have to pay interest and other, and both the values are changing, and how does this value change go, and how do you balance assets and liabilities and blah, 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 and how can we look at that as the two-body problem and do stuff with it as engineers, okay? So I want to take a short break, about 10 minutes, and then we continue, all right? Heb jij nog tijd om erbij te zijn tot 6 uur, Pieter, of niet? Huh?
Ik ben bang dat ik zo moet afhaken. Ik moet naar vioolles. Maar goed,
We nemen het op, want dit is wel interessant voor jou, de rest. Huh?
Ja, precies. Nee, het is heel interessant. Maar goed, wat je nu gaat doen is natuurlijk ook heel relevant om verder te bekijken. Dus,
Juist.
Ja.
Ja, dus we nemen het op en dan kan je het zien. En dan kunnen we